We ran the GARP backtest across 17 stock exchanges from 2000 to 2025. The US returned 7.42% per year. The S&P 500 returned 8.02%. By that measure, the strategy failed in its home market. But compare each market to its local benchmark and the story changes. Germany beat the DAX by 4.40%, Hong Kong beat the Hang Seng by 4.36%, and India barely edged the Sensex at 11.75% versus 11.12%. Understanding when to measure alpha against local benchmarks versus the S&P 500 tells you most of what you need to know about evaluating factor strategies globally. The backtest runs quarterly, rebalancing in January, April, July, and October. At each rebalance date, we apply all 6 GARP filters using only the financial data that would have been available at that time. Those 6 filters are PEG below 1.5, P/E between 5 and 50, revenue growth above 15%, return on equity above 10%, debt to equity below 2.0, and market cap above $2 billion for U.S. stocks with exchange-specific thresholds for non-U.S. markets. Annual financial filings typically arrive 30 to 90 days after fiscal year end. We apply a 45-day filing lag. So at the January rebalance, only filings released before mid-November are included. Without that lag, the backtest would use data that didn't exist yet, and the results would look better than anything you could actually trade. Revenue growth uses the 2 most recent annual filings available at each rebalance date, not trailing 12 months. The PEG ratio divides the price-to-earnings ratio by the earnings growth rate. It comes pre-computed from the financial modeling prep dataset, so we use it directly. Transaction costs follow a size-tiered model, 0.5% one way for small caps, scaling down to 0.1% for large caps. That's conservative but realistic for a systematic strategy. At each rebalance, we take the top 30 stocks by lowest PEG and hold them at equal weight. If fewer than 10 stocks qualify, the portfolio holds cash. That happened 22 times in India, mostly between 2000 and 2004, and 24 times in Norway, where the tradable data only covers 2013 to 2025. The India universe here is NSE only. The full backtest code is on GitHub at Ceta Research, Backtests in the GARP folder. GARP combines 2 dimensions that usually pull against each other. Growth stocks are typically expensive, cheap stocks are typically slow-growing. The PEG ratio finds the intersection where growth and valuation coexist. A stock with PEG below 1.5 is growing fast enough that its P/E is justified by what the underlying business is actually doing. The hypothesis is that markets systematically undervalue these companies. Growth investors focus on the fastest growers regardless of price. Value investors avoid anything that looks expensive by P/E. The GARP zone, growing businesses at moderate multiples, falls between these 2 camps and gets less attention from both. The counter hypothesis is that, in efficient markets, a low PEG isn't a mispricing. It's the market correctly anticipating that current growth won't persist. The PEG looks cheap because the market expects a slowdown. If that's true, the strategy only works in markets where that deceleration forecast is systematically too pessimistic. The results across 17 markets suggest that's exactly what's happening. Here's the headline. 2 markets out of 17 clearly beat their local benchmark. The rest didn't. The U.S. story is sobering in the back half and instructive throughout. GARP returned 7.42% per year over 25 years. The S&P 500 returned 8.02%. A $10,000 starting investment grew to $63,091 in GARP versus $72,829 in the index. The strategy was fully invested every quarter, not a single cash period, and it still came up short. The maximum drawdown reached negative 52.43%, about 9 points deeper than the S&P 500's negative 43.86%. More risk for less return. The year-by-year pattern tells a different story. From 2001 through 2007, GARP beat the market every single year. 2003 delivered plus 50.8% against the market's plus 24.1%. 2005 delivered plus 48.7% against plus 7.2%. In the aftermath of the dot-com crash, genuinely cheap growth companies were sitting right in the screen's sweet spot. Those years were exactly what Lynch had in mind. Then 2008 changed the math permanently. GARP fell 50.7% while the market fell 34.3%. That 16-point gap in a single year unwound years of compounded outperformance. After 2012, GARP trailed the index in 12 of 13 years, with 2017 the only year it beat the market. Low interest rates channeled capital into high multiple growth stocks: Microsoft, Apple, Nvidia, Alphabet. The P/E cap of 50 excluded all of them during the strongest runs. India tells a more nuanced story than it first appears. GARP delivered 11.75% annually versus the Sensex at 11.12%. That 0.63% margin is barely material. The real story is the 3.73% excess over the S&P 500. But that's India's structural growth premium, not GARP alpha. A $10,000 investment grew to $174,833 versus $151,080 in the Sensex. The capture ratios versus Sensex tell the story. Up capture of 113% means that in quarters when the Indian market rose, GARP captured 113% of those gains. Down capture of 105% means that in down quarters, it absorbed 105% of the losses. That's weak protection, barely any asymmetry. The 3.73% gap versus the S&P 500 exists because India outgrew the US, not because GARP found mispricing. Germany tells a different story. GARP returned 9.52% against the DAX's 5.12%. That 4.40% annual excess is one of the two strongest local benchmark results in the dataset, alongside Hong Kong's 4.36 over the Hang Seng. A $10,000 investment in Germany, GARP, grew to $103,888 versus $36,177 in the DAX. Maximum drawdown was negative 48.42% versus negative 65.15% for the DAX. Down capture of 64.52% means GARP absorbed only 65% of the DAX's losses. That defensive profile combined with outperformance is exactly what you want from a factor strategy. The caveats remain real. India's maximum drawdown reached negative 73.42%, and volatility stayed elevated. An investor who couldn't hold through brutal stretches never captured the long-run number. The pattern across 17 markets depends entirely on which benchmark you use. Measured against the S&P 500, only a few markets outperform. Measured against local benchmarks, the story shifts. Germany beats the DAX by 4.40%. Hong Kong beats the Hang Seng by 4.36%. India barely beats the Sensex by 0.63%. The conclusion isn't that India has slower information diffusion. The conclusion is that GARP works when local market composition skews away from quality growth. The DAX is heavy in industrials and financials, sectors where GARP rarely finds qualifying stocks. GARP systematically tilts toward growth, and when the benchmark doesn't hold much growth, any systematic growth tilt produces alpha. That's not mispricing, it's sector allocation. GARP's best periods come in the aftermath of growth stock crashes, when genuinely growing companies are available at reasonable multiples because the market has sold everything. The early 2000s were a perfect environment. Its worst periods are extended low-rate regimes where capital floods into high multiple growth names and the P/E cap systematically excludes the winners. The 2010 and early 2020 were the opposite of the early 2000s, and the returns reflect that. The P/E cap is simultaneously GARP's defining feature and its most significant liability. By excluding stocks above 50 times earnings, the strategy missed every major tech winner of the 2010s and 2020s. Those stocks were expensive for a reason. They were growing fast enough and with enough quality to justify their multiples. GARP's P/E cap assumes the market routinely overpays for growth. In efficient markets, that assumption is wrong enough of the time to cost you meaningfully. The PEG ratio relies on reported earnings growth, which is backward-looking. A PEG of 0.5 based on last year's 30% growth says nothing about next year. If growth decelerates to 10%, the stock retroactively wasn't as cheap as it appeared. Revenue growth above 15% provides partial protection, but many of the strategy's worst positions were companies where growth peaked the year before they qualified. The screen couldn't see that coming. The maximum drawdown of 52.43% exceeds the S&P 500's 43.86% by about 9 points. That contradicts the intuition that buying reasonably priced growth should be more defensive than the index. In a crisis, GARP stocks get repriced from reasonably valued growth to growth at risk, and the repricing is severe. The screen provides no protection in environments where investors stop differentiating between good businesses and bad ones. That's 25 years across 17 markets. Full results, charts, and the exact backtest code are on the blog at cetaresearch.com. Link in the description. You can also run the live GARP screen yourself on cetaresearch.com and apply it to any of the 17 exchanges in the dataset. The honest conclusion is this: GARP beats local benchmarks in markets where those benchmarks don't hold much growth. Germany and Hong Kong outperform because the DAX and Hang Seng tilt away from quality growth. India barely beats the Sensex because the Sensex already holds quality growth. The US underperforms the S&P 500 because the S&P 500 is GARP's natural peer. GARP is a sensible framework for stock selection, but the alpha you see depends entirely on what you measure against. Subscribe for more strategies with 25 years of real data behind them.